In this lesson, we're going to focus on selling, one of the most important components to successful investing. In fact, most people just don't know when to sell. They sell at the wrong time, they buy at the wrong time, but they sell at the wrong time when they should be buying. And sometimes they buy when they should be selling. So you got to learn two key selling rules. Number one, never, ever lose more than 7%. And number two, take your profits if you're up 20 to 25%. And that first one, probably more important than the second one. And if you heed these two rules, you're going to help yourself become a better investor. Let's look at Facebook here. This is a daily chart on Facebook. And you can see on that chart that when stocks correct, they correct quite a bit. And if you can catch that correction early, you save yourself the anguish of watching that stock decline. So here you have a successful stock going from lower left to upper right. If you had bought this stock here, say on the left-hand side of the chart at 1980 and ridden it up to 28 or even 32, you would have had an incredible increase in the portfolio. The problem is, in each of those events, you would have had to ride down that major correction. I don't know about you, but it's painful to ride through a major correction. I'd rather sell at the top, wait for the correction to happen, and buy at the proper buy point again. But it's a tough mentality to get. In fact, this little move right here is 12%, and this big move right here is 30%. Wouldn't it have been better just to take your money off the table when you're down 7%? So here's a weekly chart of 3D Systems, one of the best performing stocks over the last couple of years. And if you just look at it, nice chart from lower left to upper right, beautiful chart. It went from $3 on the left side of the chart to over $60 at its high. But there are still some major declines that you would have had to sit through if you didn't have a selling rule. So for example, this one here is a 34% decline. Right here you have a 42% decline. And here, even though it doesn't look like much, it's a 50% decline. So even the best stocks have some corrections. And if you have a rule, you can avoid all that pain of having to sit through that correction, especially if you're in a profit situation. So since we're on this chart, let's not just look at this from the 7% loss rule perspective. Let's also look at this from the gain perspective, the 20 to 25% gain perspective. On the chart, you're going to see several spots, starting here on the left, where you had several big gains. One of them is obvious. It's sticking out. It says 46%, but there's one right before that, and that's a big gain as well. And that looks like about a double. So if you had taken your profit off the table and not sat through that little correction there, then you would have been better off. But hanging into that correction, you did okay. That's because it's an early stage base. Then you started to really get into the rocky roads. The stock went up from there, tried to break out, and then had a big steep correction, which we just showed you a minute ago. And then it tried to correct again, regain it, and then it lost again. And then this time it had a really big correction. The next time it went up 22%, and then a slight correction after that. And if you had kept buying in that ascending base, you would have made it up to the next spot, which is really getting late in the base stages. And there's also another correction. So just imagine if you take your losses off the table at 7%, and when you go up more than 20, 25% and the volume starts to die, if you immediately take that profit off the table, unless that stock is just going to run and you can sit through that correction, that's where the art is. It's not always taking the 20 to 25% off the table when you got the profit. It's using that profit to get a cushion so that you can sit through some of those big corrections without losing your money, because that violates another rule, which is never let a profit turn into a loss. So you always want to try to keep a profit going if the stock is strong, but take it off the table if it starts to fail or starts to change its personality. That's really the key. So the two rules come into effect there. Take the 7% off when you're down from your proper purchase point, and when you're up 20 to 25%, take that profit off the table if the stock stops running and starts to change its personality. And then just get back in if you like that stock so much. Get back in when it's on the trend back up and you're buying it at the proper buy point again. So to close out this segment, just imagine that you're landing a plane And the takeoff's important, the flight's important, but if you don't get that landing right, if you don't get the selling right, it can end in disaster. So using a couple of key selling rules that you cannot violate or that you make exceptions for only in certain situations, like when there's strong volume and that stock keeps going up, then you can continue to ride that 20 to 25% profit and break that rule because you have good reason. But you have no good reason on the 7% down, because stocks that go down 7% continue to go down. So land that plane right, bring it in for a smooth landing, and your trading will be smooth too.